Welcome back to Beyond the Benchmark. I'm Ryan Kasper. This past week delivered a mix of policy clarity and crosscurrents in the data, giving markets plenty to digest as we move further into the new year. The Federal Reserve meeting came and went largely as expected, with policymakers holding short-term interest rates steady. The tone of the meeting reinforced the idea that current policy remains appropriate, with consumer spending still described as resilient and business investment continuing to expand. Labor conditions were characterized as stabilizing after a period of gradual softening, while inflation was again acknowledged as elevated, though less alarming than earlier in the cycle. The key takeaway was a Fed that remains cautious, comfortable waiting for clearer data before making its next move, even as a couple of dissenting voices pushed for cuts. Inflation data reinforced that patience. Producer prices rose more than expected in December, driven by increases in services, transportation, and capital equipment, suggesting some lingering cost pressures beneath the surface. While year-over-year inflation remains elevated, it continues to look more concentrated rather than broad-based, keeping the Fed from feeling rushed in either direction. On the growth side, there were some encouraging signs. Durable goods orders rebounded strongly, helped by transportation and continued investment in equipment tied to technology and AI infrastructure. Housing prices also edged higher, though at a modest pace, with gains increasingly concentrated in northern regions, while the Sun Belt continues to cool. The housing market appears to be settling into a slower, more regional pattern rather than one driven by broad national appreciation. The consumer, however, sent a cautionary signal. Consumer confidence fell sharply in January to its lowest level in more than a decade, with concerns about inflation, job availability, and affordability weighing heavily on sentiment. Interestingly, this drop in confidence hasn't yet translated into a collapse in spending, but it's a reminder that psychology and fundamentals don't always move in lockstep. Labor market data remained steady overall. Jobless claims declined again, suggesting further normalization after year-end distortions. While recent layoff headlines grabbed attention, the broader data still points to a labor market that's cooling gradually, not deteriorating rapidly. Markets reflected this mixed backdrop. U.S. equities finished the week unevenly, while international stocks outperformed, helped in part by a softer U.S. dollar. Bonds were little changed domestically as short-term yields eased slightly and longer-term rates ticked higher. Commodities were mixed, with energy prices rebounding sharply amid geopolitical tensions, while precious metals pulled back after a strong run as expectations around policy and the dollar shifted. So the takeaway this week is one of balance. Inflation remains sticky but contained, growth continues at a slower pace, and markets are adjusting to a world where policy is no longer moving aggressively in either direction. As always, diversification and discipline remain critical as investors navigate policy uncertainty, geopolitics, and evolving economic conditions. I'm Ryan Kasper. Thanks for tuning in to Beyond the Benchmark. We appreciate your partnership, and we'll see you next week.